Everyone knows that he was a teacher mentor to Warren Buffett, and also he was very instrumental with the Securities Act of 1933. Can you imagine that public companies didn't have to disclose independent audit financial statements to their investors? That's pretty crazy. So he helped making sure that public companies would disclose their audited financial statements, which is very important to you as an investor. So I really like him. And he also has one of the most famous investing books of all time, The Intelligent Investor, which I highly recommend you to read. And it's a great book for investors to read, especially if you're a beginner or you're a mogul girl or guy. So then I'm going to kind of take you a little bit to some other very interesting ones you may or may not have heard. So I really like this guy right here. Let me see, where is he? In my notes. This guy, Jess Livermore. Now, that's back in the day. He had no formal education. That's why I'm picking Jess Livermore. He had no formal education or stock trading experience. He was a self-made man. So, and you know, he learned from winning and losing. And he was, by his early teens, at the age of 15, he had stock gains of over $1,000, which back in the day, way back in, because he's from like the 1900s, maybe around like 1920. Don't quote me on that. But so I am just saying, girls and guys and beginner investors, we don't have like a college degree in stocks or a financial degree in stocks. We're not on Wall Street trading stocks. We're not working at a broker house, and we don't have a lot of stock trading experience. So if this guy can do it, we girls and guys who are beginners can also do it too. But I highly recommend you to study, educate, and learn. And remember, these are my opinions, and I'm just doing it to inspire you. So let's go a little bit back further with John Neff. John Neff. He was popular with the Windsor Fund, and he had big returns. So that was one of the most, he was considered a value investor, and he also focused on companies with very low price to earning ratios, and also those that gave strong dividend yields. So as a beginner investor, always make sure the price to earnings ratio, which is the P/E that you see when you read stocks, the ratios that you're looking at companies with low price to earning ratios. And you know, we love strong dividend yields. Those are always pluses when you're an investor. And let's see, Thomas Rowe Price Jr. And these are older guys, but I wanted to just tell you, if there's a girl, I would be happy to tell you about it. But right now, these are just guys. So Thomas Rowe Price Jr., he's considered to be the father of growth investing. And he was one that was in the Depression. And so to be in stocks in the Depression, like the other investor, Jess Livermore, those are to get out of that depression when you're not a millionaire or multimillionaire with fat money that you're born with, and you're just a regular person. So, and Thomas Rowe Price Jr., he viewed financial markets as cyclical. So that's something that he did, and his investment philosophy was on individual stock picking for long term. So there you go, long-term investor. And let's see, John Templeton. These are once again in the past. So he's known as a top contrarian, and he once again was during the Depression. He was from the Depression times. He bought low and sold high, which is a common thing. Get the stocks when they're undervalued and sell them when they're high. And he created the world's largest and most successful international investment funds. He created some of them. And he had the Templeton Fund, and he sold it to the Franklin Group. And they said, Money Magazine called him one of the greatest global stock pickers of the century. And also, he was knighted by Queen Elizabeth II for his many accomplishments. So he might be someone that you want to look at and read about and study how he picks stocks and what he likes. Then Peter Lynch, I told you I really like Peter Lynch. He managed Fidelity Magellan Fund, and he grew the fund's assets from $20 million to guess how much? You ready? You think, oh, he doubled it. Oh, he tripled it. Oh, he quadrupled it. He grew the funds from $20 million to $14 billion. Can you imagine how happy the investors are with him as your fund manager? So you really want to look, if you're going to do any funds and invest in a fund, you really want a great manager that can really just grow your funds. And they said that Peter Lynch beat the S&P 500 benchmark for 11 of the 13 years, which is pretty incredible, giving him an average return of 29%, which you can't get a 29% return on your money at the bank or stocks and bonds or treasury bonds. So, but like I said, all stocks are risky. They go up and down in the market. So I really like him. Let's see, Warren Buffett. We all know that name pretty much. He's always sitting with his can of Coca-Cola, the older gentleman from Berkshire Hathaway. He basically went and studied with Benjamin Graham, the first gentleman that I told you about, and he amassed his multi-billion-dollar fortune from his company called Berkshire Hathaway. And he just is sitting on a big old pile of cash. He just donated some money to charity, and he plans on giving all his money away to charity. So, and he has great talks. You can look him up on YouTube. That's Warren Buffett. And then this is 6, John Jack Bogle. He is the founder of Vanguard Group Mutual Fund Company. And that he turned that into one of the world's largest and respected funds. So, and everyone has heard of the Vanguard Group. So you might want to be looking into that. And he created and introduced the first index fund, and the first index fund is the Vanguard 500, and that was established in 1976. And he likes to invest in a broad-based index mutual funds that, they're characterized as low cost, low turnover, passively managed, and no load. And here, number 7 is Carl Icahn. That's Icahn. He is an investor, and he did a hostile takeover of, remember TWA? And he's famous for the Icahn lift. It's a Wall Street catchphrase that describes a bounce in a company's stock when they go up. and so that's Carl Icahn for you. And William H. Gross. William H. Gross, he's considered the world's leading bond fund manager. And we all know about bonds. He's considered the king of bonds. And he's the director of a PIMCO family of bonds. And they have more than $600 billion in fixed income assets under his management. He is managing over $600 billion, and probably now it's even more. So that's just incredible. He puts him in the Hall of Famer. Yes, so those are some interesting ones, and I'm going to tell you a little few more for those that are listening, because I always like to tell you about that. I told you Bill Gross, he's the king of bonds, and so that we talked about John Templeton and the Depression, Carl Icahn. We told you about Peter Lynch, even George Soros. Some people may have heard about him in the news or not, but George Soros, he's known as the man who broke the Bank of England. And so that's crazy. What are you saying? And so in September 1992, he put $10 billion. That's $10 billion on a single trade. And he shorted the British pound. Oh my gosh, guess what? His investment, he was right. In one day, in a single trade, he made over $1 billion. And they said that trade netted him almost $2 billion. So, and he's also he's known for the quantum fund that he runs. And that quantum fund, I'll spell it for you, Quantum, quantum fund, has an annual return, like an average annual return of more than 30% while he was the lead manager. So that's very interesting. And here's someone, I'll give you guys bonuses for listening. Michael Steinhardt. He has a track record on Wall Street, 20% compound average annual returns. So that is more than double of what the S&P 500 did in the year. And he did it for over 28 years. And to beat the S&P by double, and for 28 years, he did it with stocks, bonds, long and short options, currencies, and they said time horizons ranging anywhere from about 30 minutes to 30 days. So he's a very strategic trader. And trading is something that, you know, if y'all are skilled and can do, all the power to you. That's something which I'm not an expert in, but there are people out there that make a lot of money by knowing how to do that. But it's very, very risky. And so I hope you enjoyed my list, because I really would like for you to study. And I just want to just give you the 8 fundamental principles of Peter Lynch. And he's the one I told you that grew Fidelity Magellan Fund from 20 million to 14 billion. So he said, number 1, you're going to, I guess basically, you know what you know. Like, we're beginners. So we're just beginners. We know there's stocks. People make money in stocks. People lose money in stocks. We know that if we can diversify our portfolio with stocks, bonds, savings, 401k, IRA, know how to like get the best bang for our buck, to get like to not get taxed so high. Because if we're just doing earned income, we're taxed at the highest rate. And all our money is taxed that we make, not like all, but like a big 38% plus tax comes out from federal and state taxes and social securities and all those other taxes that you have to pay. So know what you know. We just start. You just start at the beginning. You're in the Monopoly board. You're in square one. Like, you're starting at begin, start. 2, it's futile to predict the economy and interest rates. So to be a predictor, predicting the economy, predicting interest rates, foretelling the future, being a fortune teller, trying to, figure out the future. It's like, he said it's futile. 3, he said, you have time to identify and recognize some exceptional companies. So there's over 500 companies, in the S&P 500, because it tells you exactly how many are in there. S&P 500, but there's the Dow 30. There's just there's USA companies, there's China companies, there's London companies, there's Italian, French, Indian, Brazil, Mexican. There's just so many countries and so many companies. So really try to find some exceptional companies. So study and do your due diligence. Then 4, avoid long shots. That's like, you're not a bettor. You're not going to the horse races. And old Betsy that entered the thing that everyone told you, well, old Betsy, she's been training. And now, she's just got it in her to do one last run. And she's going to beat all these other business horses. So avoid long shots. If it sounds too good to be true, it probably is. Red flags. So 5, have good, good management is important. So when you're looking at stocks and they say buy good business, like what kind of business is it? Do they have cash flow? Do they have cash? How big is their debt? What's their P/E ratio? Does everyone buy it? Do you like it? Are like people, only going